Welcome to April. That means the end of the first quarter of the year. We're into the April showers that hopefully bring some Mayflowers. It's certainly starting to feel like spring is finally just around the corner with the weather warming up. So, with the end of the first quarter, we'd like to take a little bit of time and go through the numbers of what the first quarter was. I'm just going to share my screen here with you, and we'll take a quick look. So as we go through, we'll have a quick little snapshot of what the year was like, or sorry, the first quarter was like. And when we look at the TSX, the Canadian market at the end of the first week of April, partway through there, the TSX was up for the quarter. Year to date, obviously 4.4%. TSX up 3.4. However, the US was negative. And we started out the year quite strong. January and February were strong months in the market, and that was following 3 really good years in the market. And so now what we've got is we've got a bit of weakness seeing in the US, which has brought the year-to-date down for the world. However, Europe remains slightly above emerging markets, and the UK being the strongest, followed by Japan. So as we look through here, let's take a deeper dive into the Canadian market. So year-to-date, the Canadian market, as we talked about, was up 4.4%. There's 11 subcategories that make up the market. Energy is the number one performing market this year, year to date up 28.2%. And that energy complex, that energy index, if you will, represents just under 15% of the Canadian market. Materials is number two, representing 18% of the market, followed by conservative utilities, which is a small piece of the market at 3.4%. In 2025, the Canadian market had really strong performance, but it was largely on the back of two of these 11 categories. Materials, think of golds, and financials. So what we've got is this top half of the chart, if you will, tends to be more value-oriented securities, where the more growth-style securities, like tech, like healthcare, is showing a little weakness. But when you see the healthcare index in Canada, we really do not have exposure to healthcare stocks, which is why it's a good reason to be outside of Canada for those exposures. The healthcare index is less than 1%, just 0.3. And what falls into that category is largely marijuana stocks. That's our healthcare index in Canada. Now, when we look south of the border, we look at the energy sector is the top performing sector, but it's a tiny sector in the US, just representing 2.8%. The material space, again, another small sector. Utilities remain small. But you look at the bottom half, there's your healthcare, communication, tech, discretionary, and financials. Those are the weakest categories in the US. So as the year started out strong, we ended up moving towards, some conflict in the Middle East and looking at the U.S. and Iranian conflict. And what we saw was that escalate to a higher level, creating some market volatility. The U.S. put forth their 15-point truth proposal. Iran had a 10-point proposal. This lasted a whopping 21-hour ceasefire, so less than one full day. We're of the opinion that this conflict is not easily resolved. It's going to create some market volatility, certainly in the near to midterm. Because when you look at it, there's 5 things that outstand, and this is a little bit of a chart of showing where the attacks have taken place. Some Iranian strikes in the red, Israeli in the blue, some proxy strikes. The green is where the American strikes have taken in the Strait. And so the Strait's going to be harder to open than Washington admits. There's going to be, some bypass capacity is strained. There's no alternative route. You have to go through there. And both sides need an off-ramp. And we don't know what that currently is. We've got U.S. midterms coming up later in the year. Higher oil prices going into the midterms is not a positive outcome for the party in power. We think that there's some lasting consequences of it, and we expect oil to remain higher for longer. As we mentioned, 21 hours into a ceasefire, it ended. The gaps are really wide. The U.S. has made a bunch of demands. The blockade was announced, but the scope is limited. Trump's ordered a naval blockade of the Iranian ports starting earlier this week. And honestly, Iran's leverage is a wasting asset. I think this is an interesting thing. They control the Strait, which is their main bargaining chip, but it will likely depreciate over time. If this conflict drags on, a coordinated global response is likely to become inevitable, as Iran will lose its strongest card. The U.S. is escalating to de-escalate now. And so we see oil settling in the $70 to $80 range. Production cost in the U.S. is roughly $65. Add a $10 or $15 risk premium on top of that. And we'll talk a little bit later in the next slide. This is not the 1970s. U.S. intensity is structurally lower. Natural gas prices are following. Wage growth adjusted for productivity remains contained. The macro backdrop is still constructive. And Iran is, a counter trend correction to an underlying bull market is what we believe. We expect the back half of 2026 with what we know today to be more constructive, with the focus returning to the winners before this disruption, which are likely cyclicals, and the international markets, which we'll talk about later. This just shows, the chart shows the oil intensity in GDP. It has declined significantly since the 1970s. For all of us that fill up our vehicles as we drive, yes, we're feeling the impacts, but those impacts are not near as strong as what they were, 50, 60, 70 years ago. Credit spreads still remain, tight. It doesn't appear that there's a recession on the horizon, which is positive. However, the U.S. is now pricing in unlikely rate cuts this year, and they're more likely to hold at 3.6% this year, instead of what was believed that we would see some rate cuts in the U.S. in the latter half of the year. The picture for Canada, surprisingly, is a little bit different. Looking at seeing, rates potentially go up 50 basis points in the latter half. Market consensus is still the pink to remain flat for the year, but the market is pricing in, 1 or 2 rate increases now. Consumer confidence. This Iranian conflict has not boosted confidence, as you can imagine. And so where we're sitting here kind of at the end of March, this is, a positive thing in terms of market pricing right now. Historically, when we get weakness in consumer confidence in the stock market, we tend to get a bit of a rally later on, which is indicated by these low points here: 17.6, 43 from here, 15 from here, 22 from here. But what is definitely happening in the market for sure is we've got high stock volatility, which means, we're likely to see, a bit of a correction or a rotation. And in the last month, stocks moved an average of 10.8%. That ranks in the 99th percentile over the last 30 years. So that's extremely high volatility and rotation within the market. And that's what we're certainly seeing now. We expect that we will continue to see some weakness in the top 10 in the U.S. S&P 500 index. They represent over 40% of the index, which means the other 490 stocks that make up that index represent the other, roughly, 60%, a little bit less. When we dive a little bit deeper into the U.S. market, and if we were to remove the 10 largest names that make up the U.S. index, 9 of them are software companies, so very heavily focused on tech. If we remove those 10 largest names and look at the valuations of the other 490 companies that comprise the index, Valuations, and PE ratios are certainly not extreme. We talked about the Mag 7, which is part of the top 10 stocks: NVIDIA, Facebook, Tesla, Amazon, Google, Microsoft, Apple. 2023, very solid returns, followed by 2024 and, strong returns in 2025. That being said, here we are year to date in 2026. They've actually been a drawdown on the market. We've seen weakness in that leadership, which indicates this is what's referred to as what's called a heat map. So this is the S&P 500, the 500 stocks that make up the index. You've got Microsoft, NVIDIA, Apple, Amazon, Tesla, Google. This is Meta, Facebook. So red indicates, a little bit high in terms of valuation. Green indicates more attractive valuations. As we look forward, to the market, we're starting to wonder, is value back? The market has really been led by growth stocks, for some time now. And if you go back to that first chart in terms of performance, those 11 subcategories, the weakest performing categories tend to be growth this year so far. Value tends to be a little bit stronger. This just shows you over 2025, that valuation gap between growth and value, widened over that period of time. So we're big fans of international. We're big fans of value at this point in time in the market. When you look at the international market, this being Canada over here, Royal Bank is our largest company. We've got a lot more green. You look at the UK, Cayman Islands, you look at Netherlands, Germany, France, a global perspective, India, there tends to be a lot more green on this heat map. So that's a positive thing. Additionally, international securities and developed market securities outside the US tend to do well during periods of the declining dollar. So these purple spikes is when international securities outperformed US securities. They also happened, by and large, during periods of declining US dollar. So that bodes well for a global diversified portfolio. We expect this year to be more volatile than it historically has been. And we always like to come back to remind investors that over time, diversification, volatility goes down. This is a 1 year, snapshot from the last 75 years of what returns have been in a single calendar year versus a 5-year rolling return, 10-year rolling return, and a 20-year rolling return. So over time, the market works itself out. So that's our quick snapshot. That's our update for the end of the first quarter. We wish you the very best going into the spring. We hope the weather is, I'll just stop sharing here. We hope the weather treats you well. We hope that spring weather arrives, and we're looking forward to a fantastic summer in 2026. We wish you all the best. Should you have any questions, please don't ever hesitate to reach out to connect with us. Thank you for your time.